So today we are going to do the straight line method of calculating or estimating depreciation expense. So as we saw before, we have two methods, the straight line method and the reducing balance method. But the straight line method assumes that the reduction in the value of the non-current asset is at an equal rate. So as we had said before, if it is $4,000 is your estimated or calculated depreciation expense, annual depreciation, then that means that for every year it will be $4,000 depreciation expense for that particular non-current asset that is entered in your income statement. Now, the straight line method, to get that estimation, there are actually two ways that you can calculate it based on the information that is given. If you see a percentage, so the depreciation rate, then that means that it will be one formula, which is percentage by cost of the non-current asset. If, however, you do not see a percentage, instead they give you information like the cost of the fixed asset, the estimated disposal value, which is the amount that you will get eventually after you have used the non-current asset. It has come to the end of its useful life for you, the business. After that, you may be able to sell it and get some money, scrap it and get some money, or you will get nothing for it because it is of no value. But that is an estimate that will be taken into account when you are calculating your depreciation, your annual depreciation. And then, of course, you will also be estimating how long do you think this particular non-current asset is going to be useful to you. So some people believe that a motor vehicle is the most useful to a business, especially for 3 years. Some might think for 5 years. Some may think that they can get everything out of that motor vehicle for 10 years before they have to dispose of it and get a new one. So that will be an estimation, and you will use that estimation to calculate. So going into detail, we will just look at the first one, still the straight line method, but the first one is when they give you a percentage, so a depreciation rate. So the information that you will be familiar with, or you have to be familiar with depreciation, would be the cost. And what is the cost? As we said, the cost is the purchase price, and anything that requires getting that particular non-current asset to be in working condition. Because remember what we said, it is only an asset if it is useful and used. So basically, cost, purchase price. For CSEC, that is all you basically have to know, purchase price. Depreciation rate will be the rate that they give you, that they estimate is the percentage or the rate at which it reduces in value because of use. In other words, the rate at which it depreciates. Annual depreciation is in using up that particular non-current asset for the year, how much did it depreciate by or reduce in value for that year. So that is what we are going to be calculating. What is the annual depreciation? Whilst you are using it over a period of time, because you do not just use it for a year and then you get rid of it. Remember, it is a non-current asset. So being a non-current asset, it is used for more than a year. After you have calculated your annual, of course, as you use it every single year, the depreciation or the reduction in value will be accumulated or add up. So it is going to depreciate total. That is called your accumulated depreciation. So if your annual is $4,000 and you use it for 5 years, $4,000 each year multiplied by the 5 years will give you $20,000. So that will be your accumulated. And then your net book value is basically what is the value of your non-current asset after it has depreciated because of use. So in a particular year, you will just be stating what is the value after depreciation, after accumulated depreciation, after it has been used and totally reduced for that period of time. That is your net book value. But to calculate your annual depreciation, you will only need to know your cost and your depreciation rate for this method. And that is how you will calculate your annual depreciation. So as we said, annual depreciation, straight line method, if you're given a percentage, it is percentage by cost. So for example, you have a motor vehicle that costs $20,000. The depreciation rate is 20%. So therefore, what will be the annual depreciation using the straight line method? You will simply just have your formula, which would be percentage by the cost of the motor vehicle, which is 20% of the 20,000. So you see your cost is 20,000. Your depreciation rate is 20%. So 20% of 20,000 gives you $4,000. So this will be your annual depreciation for the useful life of the particular motor vehicle, in this case, the non-current asset. So the question can also be asked, based on this estimation, how long did the business believe that the car or the motor vehicle is going to be useful to the business? 5 years. How did we get 5 years? If it's $4,000 depreciation annually, and the cost is 20,000, that means 20,000 over the 4,000 gives you 5 years. So the 20,000 reduces in value by $4,000 over a 5-year period. That means as well that there is no value at the end of the useful life. At least this is what is estimated by the business. So here is an example, and here's the information. Basically, you have your non-current is a motor vehicle again. We just love those motor vehicles. The cost of the motor vehicle, which was purchased in 2011, is $40,000, and the depreciation rate is 20%. So you have straight line method is what they are asking you to estimate. So you first will work out your annual depreciation using the straight line method. Since they gave us a percentage, that means that the working will be 20% multiplied by $40,000, which will give you $8,000. So this will be your annual depreciation for the period every single year, since it is the straight line method. So based on that now, what is the cost of the fixed asset? The cost of the fixed asset, once again, is the purchase price. So for every single year, it will be $40,000. Purchase price does not change. You're not a speedster. You can't go back in time and change it from 40,000 to 32,000 or something like that. Whatever you purchased it at, that is called your historical cost. Whatever you purchased it for initially will be considered the cost of that non-current asset for its useful life. So in this case, it's the $40,000. Accumulated, as we said, is your total. So at the end of 2011, it depreciated by 8,000. So that means in total, for having used it for 1 year, it will be 8,000. So because of the 8,000 that has been accumulated, you have your net book value, cost minus the accumulated. Remember, the net book value is the value after it has depreciated for that period of use. So basically, 40,000 minus the 8,000 will give you $32,000. Why do we have it in brackets here? There's a reason why we put it like this. Basically, the balance sheet, which we will do in another lesson, is set up exactly like this, where you have the cost, the accumulated depreciation, which is minus or subtracted from the cost to give you your last column, which is your net book value. So basically, when you write it out like this, the cost is 40,000, the accumulated is 8,000. Get accustomed, put it in brackets one time, so you know for your net book value, 40,000 less 8,000 will give you $32,000. Nice and simple, easy. Good, you just go to 2012. Remember, it's the same 8,000, but now we have used it for 2 years. So that means the accumulated is 8,000 plus 8,000, or 8,000 by 2. How you can also look at it is you had an accumulated here, 8,000. It depreciated by a further 8,000. So that means that in total, it is 16,000 as the accumulated. And then to find your net book value, the last column will be 40,000 minus the 16,000, which will give you $24,000. And then we have 2013, same 8,000. What will be the accumulated? Looking at it, is 3 years of use. 8,000 multiplied by 3. So you have 8,000 multiplied by 3 will give you 24,000. Or you could have looked at it as before it had a depreciated value. So it had depreciated by $16,000 at the end of 2012. It has now depreciated by a further $8,000 in 2013. So that means that it now adds up to the 16,000 plus the 8,000 additional, 24,000. And then you just do the same thing. Cost minus the accumulated gives you your net book value of $16,000. So you're seeing where the value is just reducing here. It's going down. The net book value is just going down, right? The value of the motor vehicle is being reduced. It is deteriorating. It is depreciating. Fourth year, annual, 8,000. In total for 4 years, 4 by 8 will be the 32,000, or the 24 add the additional 8,000 for that year, 32,000. Net book value, 40,000 minus the 32,000, which gives you the 8,000. And then 2015, 8,000 annual. This goes in the income statement. And then for your balance sheet, your cost is always the 40,000 unless more motor vehicles were purchased. That's the only time it will change. The accumulated will be the 32,000, add the additional $8,000, or 8,000 annual by 5 years, and that will give you $40,000. And what you would realize here is that 40 minus 40,000 will give you 0, meaning that there is no estimated value for that motor vehicle at the end of the 5-year period of use. So this is how you will do a table like this with all of the information. The exam does not necessarily come like this where they give you a table and you have to calculate each of these things. If it does, well, this is how it is done. But this is basically information that is to be used for the income statement. Income statement will be your annual depreciation, which was calculated using the straight line method with the percentage. And then, of course, your balance sheet would have your cost accumulated and your net book value for each year. So for 2015, if you do a balance sheet for 2015, then your cost will be 40,000, your accumulated will be 40,000, and then your net book value would be 0. And the same thing, if you were to do a balance sheet for 2014, then your cost will be 40,000, your accumulated would be 32,000, and then your net book value would be $8,000. We will do the balance sheet in another lesson. What we are going to do now is we are going to look at the other way that you can calculate annual depreciation, still using the straight line method, but this is if they do not give you a percentage. If they don't give you a percentage or a depreciation rate, then you will use the formula, the cost of the non-current asset minus an estimated disposal value. Remember, the disposal value is how much money you think you're going to get at the end of the estimated useful life. If you sell the car or you sell it for scrap, or you get nothing, right? Zero, like in the previous one, over the estimated useful life. As we said before, you can estimate, you think that this particular non-current asset is going to be useful for 5 years, 10 years, 20 years, 100 years, whatever is your estimated useful life. This is why the land does not depreciate, because land has a useful life indefinitely. Yeah, think about it. That is the main reason why land does not, or the reason why land does not. Okay, so we know cost. Once again, these definitions are in your books and stuff. So you know that there's the cost, which is your purchase price. You have your scrap or disposal value or your residual value. You can see it like that in the different questions. So estimated amount that the business expects to get after they have used it for its useful life, after they dispose of it. The estimated useful life, which is the estimated amount of years that this non-current asset will be will be useful to the business in generating income. Annual depreciation is what we are calculating. Accumulated depreciation is your total depreciation over the whole useful life of the fixed asset or the non-current asset. And the net book value is the value, if any, that you have at the end of the useful life. The net book value is supposed to be the disposal value, basically, right? That is what you're supposed to end up with. That is why it is estimated, it is used in the calculation of the depreciation, because they estimate that it will have a value of whatever your disposal value is estimated at. Once again, for your calculations, you only need cost, disposal value, and estimated useful life. So in this method, as we said, you're using the formula instead of the percentage. So it will be example, motor vehicles, the same 20,000, but instead of giving you a depreciation rate, they told you an estimated disposal value, $5,000, and an estimated useful life, 5 years. So you would use this information to calculate what your annual depreciation is using the straight line method. Formula, 20,000, which is the cost, minus the 5,000, which is the which is your estimated disposal value, and then 5 years. And that will give you $3,000 as your annual depreciation. So doing 6.25, it's the same procedure. First thing that you're going to do is you're going to work out what your annual depreciation is. So your annual depreciation, they did not give you any percentage or depreciation rate. So you're going to use the information that they did give, which is the 16,000 as your cost. they said 4 years is when it's going to be useful to generate income, and the disposal value that is estimated at 4,000. So we go down to our working here, and there's our formula, cost minus disposal value over useful life. 16,000 minus the 4,000 estimated, and then 4 years will give you $3,000. So that means this is your annual depreciation, meaning that it will be your depreciation for each of the years. So 3,000, 3,000, 3,000. You can just put it there one time for straight line method because it's the same amount. Your cost will forever be the 16,000 because we cannot change time. So this is your historical cost, 16,000. Accumulated will be how much is your total at the end of that year. So year one, you accumulated 3,000, so it's 3,000, and net book value cost minus accumulated 13,000. 2 years, you accumulated for 2 years 3,000 by 3,000 or 3,000 by 2, 6,000. Net book value 16,000 minus the 6,000 gives you 10,000. Third year, accumulated for 3 years 3,000 by 3, 9,000. 16,000 minus the 9,000 will give you 7,000. And then fourth year, or the last year, 4 years by the 3,000 will give you $12,000. 16 minus the 12,000 will give you a net book value of 4,000, which is the amount that you estimate will be your value at the end of the 4 years, and you should be able to get $4,000 for it. Okay, so these are the two ways of calculating annual depreciation using a straight line method, which means that depreciation expense is the same for all of the years. So each year during the useful life of the non-current asset. In another lesson, we are going to do the reducing balance method and the way that you will calculate. That is simply, instead of percentage by cost, like your straight line method, it is going to be percentage by net book value. So stay tuned for the next lesson. Look out for the next lesson where we will go into that in detail.